Welcome to this edition of IBFD's Tax Takes, News and Views, bringing you the week's tax news in a nutshell. I'm Barry Larking, Special Counsel at the IBFD, and with me for our Beyond the News interview is Stuart Gibson, IBFD's Chief Editor, Global News in Washington, D.C. On today's show, Spain launches a digital services tax while France revives its own. Could this be the start of a new trade war with the US? Just 6 out of 8 countries score a passing grade on the OECD's dispute resolution standard, and Spain adopts a financial transactions tax. These and more, including Stuart Gibson's interview with Giorgia Maffini, Special Advisor on Tax Policy and Transfer Pricing with PricewaterhouseCoopers, coming up on IBFD's Tax Takes. First, we turn to the top news of the past week, as reported in IBFD's Tax News Service. As expected, the G20 finance ministers have come out in full support of the 2 blueprints for global tax reform that the OECD released last week, reaffirming their commitment to achieving a globally fair, sustainable and modern international tax system. But even though the G20 nations account for the lion's share of the world's economy, they represent only a fraction of the 137 inclusive framework members that are trying to reach consensus on the reform proposals. So reaching that consensus may require just more than just this latest commitment from the G20. Just as the G20 was applauding the release of the tax reform blueprints, Spain and France were taking steps to implement their own Plan Bs in case consensus cannot be reached. Spain has enacted a new 3% digital services tax set to begin in 2021, while French Finance Minister Le Maire announced that France, which had postponed collection of its 2% digital services tax to enable global talks to continue, will begin collecting that tax in December. The French move is a direct response to the failure to reach consensus this year, while the Spanish proposal has been on the table for the last couple of years. The question now is whether the US will make good on its threat to impose trade tariffs on French luxury goods that had been postponed when the French backed off on collecting the tax earlier in the year. And it should not be forgotten that the US is threatening to impose more tariffs on the importation of goods from other countries, like Spain, that enact their own digital services taxes. That seems all the more likely in light of recent developments at the World Trade Organization in the long-running dispute between the EU and the US over illegal subsidies to aircraft manufacturers. While the OECD is trying to work out new approaches to addressing disputes that may arise under its global tax reform plans, it has just released the latest in its series of peer-reviewed evaluations of existing dispute resolution procedures, this one covering 8 countries. These reviews are designed to compare how existing procedures measure up to the minimum standard that the OECD laid down in Action 14 of its 2015 BEPS Action Plan. One takeaway from the review is that 6 out of the 8 countries have decreased the time for closing mutual agreement cases, one of the goals of Action 14. However you view the result, there is clearly still room for improving the dispute resolution process. While the eyes of the world are focused on the OECD's 2 pillars, Spain has revived the idea of a financial transactions tax, once seen as an instrument of global economic change and more recently featured in the EU's economic revival plans this summer. While the idea has been on the agenda of some EU member states for a number of years, it's met with strong resistance in some corners of Europe, particularly from member states that host major exchanges. Spain now follows a small number of member states that have decided to go it alone, and it will start applying the 0.2% tax to acquisitions of shares in large Spanish companies as from next year. And now moving on to other news. While last week the spotlight was on Swedish and Dutch blacklists, this week it's El Salvador's turn to publish a list of tax havens and preferential tax regimes for 2021. And payments to recipients on that list will be hit with a 25% withholding tax unless they're covered by an exemption. Some might be surprised to find that the list includes almost half of the current EU member states. Others might be even more surprised that Luxembourg and the Netherlands are not on the list, given the criticism often levelled against these 2 countries for their preferential tax regimes. And finally, a US businessman has just been charged with evading income taxes. on $2 billion in what the US Department of Justice has called the biggest ever tax case against an individual in US history. The charges read like a spy novel in places, recounting the taxpayers' alleged use of dummy nominees and coded emails to direct to complex companies and trusts in Bermuda, Nevis, and Switzerland. As governments continue to exchange financial information and journalists continue to dig, this is unlikely to be the last prosecution we see on this scale. And with that, over to Stuart Gibson to take us beyond the news with his guest expert today, Giorgia Maffini. Stuart.
Thank you, Barry, for your informative news report. I'm Stuart Gibson, Chief Editor of Global News here at IBFD. I'm joined today by Dr. Giorgia Maffini, Special Advisor on Tax Policy and Transfer Pricing with PwC in London. Welcome, Giorgia.
Thank you, Stuart. Really great to be here with you on the IBFD platform.
We're so happy to have you. Some people who've closely followed the OECD's work on the tax challenges of digitalization may know you from your work at OECD, but others may not know that you're an economist, not an attorney or an accountant. Speaking as an attorney, that may be a good thing. Could you tell us briefly how you came to work on the BEPS project and what role you played at the OECD?
Yeah, Stuart, so at the OECD, I was the Deputy Director of the Tax Policy and Statistics Division. That's the division of the tax department of the OECD, where the economists and the statisticians sit. And in 2016, so when we first started working on the project of the taxation of the digital economy, just after BEPS, it was very clear that there was no consensus on the need to change, the corporate income tax system beyond what BEPS had just achieved. So we had to take a step back and think, what are we looking at? Are there unifying elements of this debate that can be shared across countries? So in 2018, our interim report focused on the analysis of the business models and how they evolved with digitalization. And this is clearly where a tax person with an economics background can be useful. And our analysis of business models seemed very neutral at the beginning, but as everything in this debate, it turned out to be pretty controversial because, of course, it's about whether there is value in the market and hence taxing right.
That sounds like you played a critical role, at least in helping define the problem and define how the solutions might work. So now, instead of helping OECD formulate policy on this issue, you're on the other side. You're helping businesses comment on and eventually implement that policy. Having reviewed the latest blueprints on Pillars 1 and 2, what do you think the business community in general should be happiest about from the latest drafts?
I think that essentially we should be very happy that the basic architecture of Pillar 1 and Pillar 2 and a lot of the design details about those two pillars is out there now for everyone to comment and to think about. I think it's a very, very good development because business can now, test the effect of both pillars on their structure, on their business models, on their financial figures. And I think this will, so that business community can feed all this learning back to the policymakers who want to listen. And I think this starts a process whereby we can get to a better Pillar 1 and Pillar 2, really, because it's difficult to think that such a structural change for the system can be accomplished and implemented without a meaningful interaction with the business community. After all, this project is all about business and business taxation.
It sounds to me like the business community should be happy that they're being listened to and that they're being given an opportunity to comment and shape the final product. Can you talk to us about what you think should concern the business community the most?
I think, Stuart, that from what we hear from our conversations with the business community, we think that a unifying worry is the compliance burden of both Pillar 1 and Pillar 2. I think the feeling is that we are looking at a compliance burden that goes beyond anything we have experienced before, for example, with BEPS. And this compliance burden could be even worse if countries implement the two pillars in a way that is not homogeneous across jurisdictions. And so maybe we can make on this platform the first proposal for a working group on simplifying and implementation issues around Pillar 1 and Pillar 2. But I think this is an area where we really need a lot of work. And maybe a second element that worries me a little bit, and I think is sinking into the business community now as well, is the broad direction of the system after Pillar 1 and Pillar 2. And in particular, if we think about amount A in Pillar 1 and the minimum effective tax rate in Pillar 2, these two concepts do not have a strong theoretical principle behind them. So it seems to me that they look more like negotiated numbers. If they are purely negotiated numbers, clearly they can be changed quite easily and increased. And so if we increase amount A little by little and increase the minimum effective tax rate little by little in the next few years, this will really take the system, the corporate tax system, in a direction that we haven't really analyzed and discussed enough. So I think that this is a worry. Okay, and of course there are many more points of detail that we can't answer here, but these are the two broader worries that I think we should have.
So on your first point, it sounds to me like you're envisioning a process like the international tax community came together on when they developed common standards for the common reporting standards or for automatic exchange of information, so that there's a common understanding of what's expected. Would that be accurate?
Absolutely, Stuart. I think that a process like that will be necessary to make sure that, we design the multilateral instrument need to underlie both pillars and a process that resolves all the issues around, nexus and various other points. Yeah, absolutely. And the exchange of information that authorities will have to have in place to avoid double taxation, for example.
So it sounds like there may be hope there. Let's assume, and this is not exactly a foregone conclusion, that the members of the inclusive framework can bridge the gaps that now divide them on policy issues and reach consensus by the middle of next year on the core features of the two blueprints. The OECD estimates that those changes will add about $80 to $100 million to global tax coffers every year. How do you see those changes affecting the bottom line of any given multinational enterprise?
Yeah, so it's important to say that agreement, as the OECD has admitted, remains very difficult. So we don't know whether the two pillars will be implemented. But if we think about them, and again, taking a really broad picture view, I think that the changes in the bottom line of the company will come through mainly from a change in the effective tax rate and also through the high compliance costs. If we focus on Pillar 1, the higher the profitability of the firm, the larger amount A, and the larger the effect on the transfer pricing policy, where the exact impact on the ETR will come from the difference between, the tax rate in the jurisdiction that will pay for amount A and the tax rate in the jurisdictions that receive amount A. The larger that gap, the larger the effect on the effective tax rate. And probably in terms of real life business models, this means that the impact of Pillar 1 will be higher, stronger on centralized business models. more than on businesses with more of an entrepreneurial structure, for example. If we look at Pillar 2, the effect on the ETR is a bit more straightforward because the aim of Pillar 2 is to increase the effective tax rate in every jurisdiction up to a minimum level. And maybe we should say that in our experience, the effect of Pillar 1 is smaller on the ETR than the effect of Pillar 2. This is not always the case, but often the case. And this matches quite a bit with the impact assessment that the OECD has carried out. And then we have, the impact of the high compliance costs. As we said before, both pillars seems to imply very high compliance costs. This translates into substantial costs of doing business. And this has an indirect but very concrete effect on the bottom line. And we should remember that when the compliance costs are high for the taxpayer, they are high for the tax authority as well.
So I'm going to cut to the chase and ask, do you think that if adopted, these changes are going to increase the opportunities for structuring around tax rates, or they're going to limit the opportunities for companies to engage in the kinds of structuring that they do now?
That's a very open question, Stuart, and I think among all the questions we can ask, this is really the one that depends on the very final details of the two pillars. If we think of Pillar 2, though, let's try to take a broad picture view again. Many experts, when we talk about Pillar 2, expect that some companies will have to structure out of some jurisdictions or some countries. And the idea is that it no longer makes sense to be in some jurisdictions after their effective tax rate will go up. But I think it will all depend on where the minimum tax rate will be set and whether detailed design features will be set, like the some of the deductions that you can have on the tax base. And it will also depend on whether that specific location has been chosen purely for tax purposes, or if there are other purposes or other reasons for being there, such as, regulatory reasons, stability of the jurisdictions, and so on. And in our experience, the tax is one of the many reasons why you decide to be in one jurisdiction. So I'm not sure. We'll see with the final details of the blueprints, really.
As it sounds to me like this is a good example of the devil is in the details. More to come. Our guest today has been Giorgia Maffini, Special Advisor on Tax Policy and Transfer Pricing with PwC in London. Thank you so much, Giorgia, for your time and for your insightful comments today.
Thank you very much, Stuart. Always a pleasure to speak.
That wraps up this week's edition of Tax Takes, News and Views, the week's tax news in a nutshell. From Barry Larking and myself, thank you for watching. Here's hoping your week is not too taxing.